One of the best ways to avoid mortgage rate hikes in a recession is to improve your financial picture. This means increasing your down payment and paying down your debt. Here are some tips on how to do that. A larger down payment reduces the amount you need to borrow and lowers your monthly payments. It also helps you avoid private mortgage insurance, which can add hundreds of dollars to your monthly costs. To save up for a bigger down payment, you can try these options. Use a personal loan for down payment. This may be possible if you have good credit and can afford the extra monthly payments. However, this option may increase your debt-to-income ratio and affect your mortgage eligibility. Get down payment assistance. You can ask your family or friends for help, or look for programs that offer grants or low-interest loans for homebuyers. Some of these programs have income or location requirements, so do your research before applying. Sell some assets. You can sell things like stocks, bonds, jewelry, or vehicles to raise cash for your down payment. Just be aware of the tax implications and potential fees involved in selling these assets. Borrow from your 401k. You can take out a loan from your retirement account and use it for your down payment. This option has some advantages, such as no credit check and low interest rates. But it also has some drawbacks, such as reducing your retirement savings and having to repay the loan within 5 years or face penalties and taxes. Save more money. This may sound obvious, but it's the most effective way to increase your down payment. You can save more money by cutting expenses, increasing your income, or setting up automatic transfers to a savings account. Another way to improve your financial picture is to pay down your debt. This will lower your debt-to-income ratio, which is a key factor that lenders use to determine your mortgage rate and eligibility. To pay down your debt faster, you can try these strategies. Make bi-weekly payments. Instead of paying once a month, pay half of your monthly amount every 2 weeks. This will result in 13 payments per year instead of 12, and reduce your interest charges over time. Make extra payments. Whenever you have extra money, such as a tax refund or a bonus, use it to pay off some of your debt. You can target the debt with the highest interest rate first, or the debt with the lowest balance first, depending on your preference. Refinance your debt. You can look for opportunities to lower your interest rate by refinancing your existing debt. For example, you can consolidate your credit card debt into a personal loan with a lower rate, or refinance your student loans with a better lender. Use a home equity loan or line of credit. If you already own a home and have built up some equity, you can use it to pay off other debts. A home equity loan or line of credit lets you borrow against the value of your home at a lower rate than most other types of debt. However, this option comes with some risks, such as losing your home if you default on the loan. By increasing your down payment and paying down your debt, you can improve your financial picture and reduce the risk of defaulting on your mortgage. This will make you more attractive to lenders and help you secure a lower mortgage rate in a recession. One of the most important decisions you have to make when you get a mortgage is whether to choose a fixed rate or an adjustable rate mortgage, ARM. In this section, we will compare these two options and explain the pros and cons of each one in a recession. A fixed-rate mortgage has an interest rate that does not change throughout the life of the loan. This means that your monthly payment of principal and interest will stay the same, regardless of what happens to the market rates. A fixed-rate mortgage offers you stability and predictability, as you know exactly how much you have to pay every month. A fixed-rate mortgage also protects you from rising interest rates, which can increase your monthly payment and make it harder to afford your loan. However, a fixed-rate mortgage also has some drawbacks. First, it usually comes with a higher interest rate than an ARM at the beginning, which means that you pay more interest over the life of the loan. Second, if interest rates fall, you will not benefit from lower payments unless you refinance your loan, which can be costly and time-consuming. Third, a fixed-rate mortgage is less flexible than an ARM, as it does not allow you to adjust your payment or term according to your changing needs. An adjustable rate mortgage has an interest rate that changes, up or down, over the course of the loan. The interest rate on an ARM is usually lower than a fixed-rate mortgage at the start, which means that you pay less interest and have a lower monthly payment. An ARM also gives you more flexibility, as you can choose from different types of ARMs with different adjustment periods and caps. For example, a 5/1 ARM has a fixed rate for the first 5 years and then adjusts every year after that. An ARM also has interest rate caps that limit how much the rate can increase or decrease at each adjustment and over the life of the loan. However, an ARM also has some risks. First, it exposes you to the uncertainty and volatility of the market rates, which can change frequently and unpredictably. If interest rates rise, your monthly payment will also rise, which can strain your budget and affect your ability to repay your loan. Second, an ARM can be more complicated than a fixed-rate mortgage, as it involves more terms and conditions that you have to understand and monitor. Third, an ARM can be less suitable for long-term borrowers who plan to stay in their homes for many years, as they may end up paying more interest over time than with a fixed-rate mortgage. So how do you decide between a fixed-rate and an adjustable-rate mortgage in a recession? The answer depends on several factors, such as your financial situation. How much can you afford to pay every month? How stable is your income? How much savings do you have? Your goals. How long do you plan to stay in your home? How much equity do you want to build? How comfortable are you with risk? Your expectations. What do you think will happen to interest rates in the future? How confident are you in your predictions? In general, a fixed-rate mortgage may be a better option for you if you prefer certainty and stability over savings and flexibility. You have a tight budget and cannot afford higher payments if interest rates rise. You intend to keep your home for a long time and want to lock in a low rate for the entire term of your loan. On the other hand, an adjustable-rate mortgage may be a better option for you if you want to take advantage of lower initial rates and payments. You have a flexible budget and can handle higher payments if interest rates rise. You plan to sell or refinance your home before the rate adjusts significantly. Of course, these are just general guidelines and not rules. You should always consult with a qualified mortgage professional who can help you compare different loan options and find the best one for your situation. We hope this section has helped you understand the difference between fixed-rate and adjustable-rate mortgages and how they can affect your finances in a recession. In the next section, we will discuss how to shop around for the best mortgage deal from different lenders.